All right, welcome everyone. Welcome to the Hurley Investments Market View Commentary for the Monday, the November the 8th, 2021. Glad to have you guys here. Kind of a small group. Looks like we've got about 15 or so. But let's get into some things that I think will be helpful for you to understand what's happening and why we do, again, some more things here at Hurley Investments that people seem to always be asking me about. So with that said, I'm just going to fix the layout because it bothers me just a little bit. All right. I received an email from someone telling me about 60/40 bonds to buffer ETFs, an all-weather strategy for volatile markets. Forever, people have been looking for ways to protect their portfolios from the volatility of the stock market. And obviously, the most common way, we're going to put you in a 60/40 portfolio, which means 40% are in bonds, 60% are in the equities. So let me ask you a simple question. If you have 60% in equities, 40% in bonds, how likely are you to beat the S&P 500? Remember our last, down year was 2012? How likely are you to beat the S&P 500 knowing we had a down year in 2012, a down year, in 2008? We were up 2007 and 6, I believe. Ooh, I see a couple unlikelies. William, again, it's funny to hear from William, who is our European, and I don't know, it's, I won't call it Great Britain, but United Kingdom, Great Britain, England. I'm going to be quiet. He just made the comment, it only protects you in down years and you miss all your upside growth. Perfect. And it's funny because we hear from people all the time that are in these 60/40, 80/20s, and they're like, oh yeah, we're beating the market. And when we go through and review it, they're nowhere close. They are nowhere close to beating the S&P 500, let alone ever getting above it, because if you're looking at a 2 to 3% bond market or a losing U.S. security or treasuries bond, you've got to have a 40% increase in those 60% equities. And the funny thing is, basically, let's face it, these 60% equities, what are they? The S&P, right? It's the NASDAQ. It's the Dow. And usually it's going to be an overseas, the FTSE in Europe is a popular one. But they take that 60%, and it's either in those four, or it's in a mutual fund that 96% of the time does not beat the S&P, period. They just don't. And when you do your math and wrap your hand around it, you're someone like me that says, when you're going through an online education, like I went through with most recently Safe Option Strategies, and prior it was Options Animal. And there was also Spread Trade Systems. That's where I probably learned the most, right? Invest Tools wasn't worth their money. Optionetics wasn't worth their money. The Options Pirate wasn't worth his money. I mean, it gets bad. Let's face it. Education out there is bad. But the whole idea is to educate yourselves how to do better than a 40/60, where 40% will beat the market in a down year, and That doesn't mean it beats it. How would I say this? It doesn't mean those bonds don't lose value. Those bonds can lose, 20, 30% of their value, but as long as you stay in them, you don't lose anything over that 10 or 20 or 30-year period of time, however long your holding period is on those bonds. And then your other 60%, usually when it is the market, or in something 96% of the time does not beat the market, you just don't make money. And you can run in the market for 10 years. 10 years, I'm going to say from something like 2010 to 2020. And I know a couple people that just haven't made any money over that 10-year period, even though the market was up like 68% or something like that. And you just sit there and you scratch your head and you're like, what the hell am I doing? And for that reason, you're now trying to find something different to go into so that you can get a better return. Hold on 1 second, please. All righty, had an alarm going off there. So I found it interesting because we've got this guy that's now talking about buffer ETFs and defined outcome ETFs. And again, all it really is a 60-40 split that that's not any different than anything else. It's just pitched a different way, which is why we do what we do. We're willing to buy some insurance and we try to pick the best of the best stocks. I really have enjoyed an article that I'm going to have for you here. I've got an article here where I'm looking at some things and I'm like, all right, I got to pick the best of the stocks. If I was to ask you guys, hopefully you tell me Warren Buffett is about the best that you know of. But as I went through this Warren Buffett article, pretty neat. He's got the majority of his holdings in two positions. Apple and Bank of America. $171 billion sits in those two out of his what, 330? Apple's one of our major holdings. Bank of America's one of our major holdings. We don't believe in American Express. We do have a little bit in Coke, but Coke just doesn't move. Most recently got out of JP Morgan Chase, which is probably why our JP Morgan hasn't moved like we wanted it to. Lost money in Wells Fargo. I don't know how he did in PNC Financial, but pretty interesting to see where his money's at, and nice to see that we're in those same areas. That's what we're looking to do. We're looking to, and plain and simple, right? Here at Hurley Investments, we pick the most likely, fundamentally sound stocks that through their PE ratios can double in 2 years. That's our goal. That's what we're looking for. That's what we're trying to accomplish. That's where we're seeing what we need to do. The neat part is, if we are wrong, we add the long put as protection when stocks are most likely, and I'm pretty sure that's in that like 83% range. 83% of the time can move 10% or more in 30 days. And that's earnings, right? Earnings gives these stocks opportunity to move they're 10% or more, 83% of the time in that time period. So that's what we've decided to do to create a 60-40 all-weather strategy for volatile markets. That's what we do to make sure we give ourselves that opportunity to be protective of people's portfolio. And like last year, other than my Boeing group, a lot of you had a fabulous return, a good return. If things head down, we can pick up some shares of stock. I like the ability that what we do also gives us the opportunity to dollar cost average without having to bug you for more money. Our growth primarily comes from growing your portfolios. It's not for hounding you to bring more money over, to sell something off, to take it out of another investment. Our job is to make money for you doing what we do without having to go back after, hey, you know, if you got $100,000, stick it in, we need dollar cost average, blah, 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 blah. There's no churning of things as they go around. It just takes something that's really, really hard and patience. And it beats the hell out of listening to 40-60 bond funds, low risk portfolios, all weather strategies, blah, 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 blah. It's just not what makes people any real money. It makes my industry money, but it doesn't make money for you. And you guys are obviously in it to make money for yourselves. That's what we're here for, right? With that said, a couple people have asked me over the last week and said, well, Kevin, your Square trade ain't doing so well. So let's just go through a couple things really quickly. Going to go through general portfolio. Apple was down a little bit today. Apple hurts us because we're not protecting the stock. Our line in the sand is that 150 level. So we're trying to see if Apple can have that pre-Christmas run that should send it to somewhere between 160 to 165. Boeing, we've got a bunch of Boeing here. Condense some shares, move some stuff farther out in time. We even replaced some shares with those calls so that people could make better money. But Boeing, expectations, Boeing can get back up to 400 sometime next year with the new release on travel. That will probably come quicker than later now that we've re-enticed international airlines to also need or want Boeing jets. Bank of America. We have Bank of America right now stuck between a $46 and a $48 price target. If you look at a chart on it, really pretty interesting. Let's do Bank of America. If you just look at a chart on Bank of America, it really is trying to build that base. You can almost see it right here at 46.95, and on the top side, sitting right around 48, 48. I'd probably go more for the close, probably do a 48.21. So that's the range we're sitting at with Bank of America. All right, Baidu preparing for its earnings here in 2 weeks. We have 165 puts on. They are some short-term puts. December 3rd. we're going to be running with those. That's where we're looking to run Baidu for all intents and purposes. Short term, see if we can't get a move forward. Costco, we're just in Costco calls. Recently added some new 550s as we've taken 100% plus profit. So what we paid $43 and now we're 37. We're now going out to January 23, trying to make our another 100% return and see if Costco can't get to 550. CVS shares are just floundering. We have done some covered calls on them, and that's probably where we're going to head to in the near future. Disney has earnings on Wednesday. We're going to be a little cheap here. Disney right now is running at 176. We could technically roll these November puts just out a week, and we could roll them up to 175. That would cost us $5 to $5.20. We could protect $5 by spending $5. How much did we lose over here? We've lost 3. We could roll everything up for $5, lose 3 to protect 5. But with an opening trade, it's not that we expect Disney to beat the numbers. Our thought process is not, hey, Disney's going to knock their numbers out of the park and we're good to go. We're playing Disney as a reopening trade, where our protection that we've already spent $5.56 for is going to be down at a lower price target. Our protection is actually going to be something of a catastrophic insurance. It's like buying catastrophic health insurance. It's going to be down lower. We're not protecting right now $6.87 to the upside. We're going to see if Disney can just not even meet their numbers, but give guidance that talks about reopening their parks, especially in California, and seeing if it can't head higher on the speculation that reopening is going to help them out overall. Fact of the matter is, California is so screwed up, it's pathetic. I've got a father-in-law that, boy, can't get visitors into his hospital. It's just, if I was Disney, I'd move the hell out of California and go put an amusement park in Texas and watch the revenues do so much better than they're doing in California in general. Ford, man, Ford was at $13 not too long ago. It's now at 20. We have shares of Ford that are just running. Some of you are going, man, it seems like we've waited forever for Ford to move. And maybe we have, but guess what? Ford is now moving. Ford is in the position that, wow, fell down to $12 in May, below $12, now up to 20. What a move by Ford. In the past, I've talked about 22.50, and I think I came out to 26. I could move my price target to Ford up to 32 in the awfully near future. So that's what I'm looking for in Ford, and it's about time. Their book of business shows that that's where they deserve to be at. Facebook on a nice rebound. Nice to see it moving. The Meta platforms. It's so stupid to change your name, but I guess it's working. First Solar. Pretty interesting on where we're at here. The First Solar calls that you got for $18.45, now we're 34. You're basically at 100% return. Good to see an opportunity to take your profits off of your First Solar calls. Why is Ford up? Ford is up for a couple reasons. Number one, they have ridiculous pre-orders for some of their their electric vehicles that are coming up. Still #1 in truck sales. Still have a finance department where they finance the sale of their cars, so they get that money coming to them as well. They've been able to raise their prices. Boy, I overpaid $7,800 so I could go get my wife her new Ford Expedition after driving a Ford van for 13, 14 years. And it's funny you ask, Rich, because I have an article that says Ford is doing something it hasn't done in forever. Ford is hitting it with the Ford attracts younger and more female buyers with a new 2020 Maverick pickup truck. I think I erased the picture of it. Nope, there it is. The same size as a full-size car, but it's got a little bit of a pickup truck to the back. So pretty interesting because it's a cheaper car. It's enticing the female drivers, not as pricey as their normal pickup trucks, so to speak. And they've got a ridiculous line of back orders for, well, I guess it's contingent orders for the new electric vehicles. Upwards to 100,000 people have put, what, $150 down just to get in line for a new Ford electric truck. Not only that, I've got a friend that's really looking forward to getting the Ford Mach-E Mustang. The funny side is, and I'm just going to say this out loud, and for those of you that do own electric cars, I'm sorry if I'm going to piss you off. My brother owns one. If you like to run your radio and like to run your AC, you're going to get somewhere between 160 to 180 miles on a Tesla. I don't know if anywhere else has the same battery capability that Tesla has. So to think you can just drive and drive and drive and save all this money and do a cross-country trip, I call BS. It just doesn't work that way. I'm really tempted when you're out here in the cold. I know batteries don't hold their charge as well. I know when you have to have heat conducted, it takes more energy to do it, and you don't have the combustion from the engine because it's an electric engine. So with all due respect, this 280 miles on the newest version of the Tesla, you can barely get 180 if you use the AC, the heat, or you're stuck in traffic with the radio on the streets of California, the freeways of California. So I don't know. I mean, I wouldn't want an electric pickup truck. I like torque. Well, electricity has more torque. I just don't see it right now. So Ford's finally moving because they should have moved forever ago and they didn't take the government bailout. They're not government motors company, they're Ford Motor Companies, and they didn't need the money and then didn't take it. So about time they're rewarded, right? All right, let's see where else we're at. Micron, we finally have Micron moving back up. Some dollar cost averaging has helped here. Some people have a lot of Micron calls, but we're finally to the point where we could get out for a smidget of a break even, and that's with Micron only being around $75. Micron gets up to $90 again. We should look really good. Something that I just want to point out, instead of possibly being wrong in getting out in January 22, we go out to leaps. And leaps is another protection strategy that if you're wrong and the stock doesn't move as quickly as you would expect it, by giving yourself more time, you can still make great money and you're not in so much of a trouble of the stock not moving like it's supposed to. Thank goodness we went out to January 23 because Micron with the chip shortage has just taken it where it hurts this year. With that said, that is also going to be a good reminder for Square. Square's biggest concern or worry was, hey, will these guys get enough small business revenue to keep moving higher? Their last earnings, they met their earnings per share. Some people had them at 68 or 30, 67, or maybe it was 38 or 37. I can't remember. Well, why don't I just go look it up instead of telling you fictitious numbers? Where is Square? Square was 2 weeks ago. Nope, it was last week. Square was supposed to hit. The consensus was 37 cents. Some people were saying 38, but I had it at 37. They hit those numbers. They made it. Their revenue was off dramatically. Square's for more small business, and small business revenue is off by basically $850 million. For that reason, we did this 2 different ways. We worked on 260s with 300 short calls. We were covering ourselves to the downside so that we're going to be okay. On an earnings that just sucked. Right now on 56 contracts, let's make sure I'm also getting it right. On 56 contracts, boy, I don't like their numbers again. Down $11. Yeah, that's right. Yeah, made up 8.5. So yeah, it's about $3. We're down 16,000 right now. Our protection is in play. Love that we have it on. We're out to June 2023. Gave ourselves plenty of time. All those poor people that I think were something like 110,000 contracts betting on Square at the end of this month, gone. It's wiped out. They didn't give themselves enough time to be able to make money on their Square position. For that reason, yet again, we went farther out in time. Doesn't look great. Cost basis at $14.77, down $3 at $11.77. But we've given ourselves plenty of time to see some things come back. And again, if a small business comes back, we should look pretty good for Square. But we'll see. Under Armour, smart. Under Armour, we got protection back on it. Let's get this down. Under Armour, we've got protection back at 25. It's somewhat floundering, but we have seen Under Armour hit a level, come back down. We're doing the best we can to get that protection on, get it protected, and off we go. And then Visa, nice to see Visa slowly coming back. Glad we were smart on Visa and went way out in time. Took some profits, put the positions back on, and we're just waiting for Visa to get moving again. It's really that simple. January 23 gave ourselves, again, another year out in time to have Visa move. What I'm trying to get at for today, we know a 60-40, we know mutual funds, we know bond funds, we know all weather strategies and buffer ETFs are garbage. They don't work, they haven't worked. That's why there's so many greeters still working at Walmart. For that reason, at Hurley Investments, we do things a little bit different. We're not a short-term active trader. Thank you, Abraham. we're really looking to find areas that are weak in the market and have some of those positions come back or get the growth that we would expect it. You've already saw the briefing picture. That hasn't changed. The market recap from Y charts, pretty interesting. The S&P rose 2% the first week in November. Kevin, you have the NASDAQ, well, you have the S&P through November going up only 2.5%. Yes, I think we're going to go through some flattening, but we did get the follow through on the infrastructure bill today. We did get significantly higher numbers of employed personnel. Technology and consumer discretionary, which is sales, retail, had the biggest gains last week. I see some catch up that's occurring that should significantly help our portfolios that we're currently in, because we just had some things that just haven't moved like they should. All right, where are markets at this week? I'm going higher, even though we are approaching the overbought territory. I think we may be overbought or trend sideways as we move higher for our next leg. All I'm doing to judge that on is our historical cycles of a Christmas rally. That's all I'm judging this on. That's why I'm seeing things the way that they are right now. S&P is bullish. Again, more sideways to up would be my expectation. The NASDAQ, still technically bearish. Actually still technically bullish, excuse me. Technically bullish and still has quite a ways to run, but having a hard time clearing the 50-day simple moving average. All right, what else do I have for you? Earnings are pretty quiet this week. PayPal on Tuesday, Disney on Wednesday, Tapestry on Thursday. Thursday, we have initial continuing claims, but those will probably show up on Wednesday. Don't forget, Thursday is Veterans Day, so it's a federal holiday. The stock market is not closed, but the bonds market are. Really, come Wednesday, Thursday, Friday, probably have some lower volume of trading, but it's just because it's a federal holiday. Nothing to really judge changing your trading ideas or what have you. I was going to make just a quick comment. I like the volume on the Dow. I like the volume on the S&P. You know, slightly down through October, but volume is starting to pick up on the NASDAQ. We could really see technology take off. Something like Apple that's only up 14%, trailing the market this year, Micron, anything chip related, you could really see technology take off this last quarter and play catch up. And I'm judging that strictly on the volume. And what I mean by volume, you look right down here, volume is picking up now over the summer doldrums. So just a thought process to be thinking of. Okay, where am I going to next? I'm still keeping November at 2.5%, but I'm more likely to raise it here in the near future. Economic reports is inflationary reports. Don't be surprised if the PPI and the CPI numbers are higher than expected. Treasury budget might surprise, and we're going to have lower Treasury budget numbers. And again, initial and continuing claims will either fall into Wednesday, excuse me, or they're going to fall into Friday because Thursday is the Veterans Day, and you will not see numbers announced. Baidu coming up next week, Disney this week. Target next week. Micron and Costco out in December. Already went through for news. Warren Buffett's equity is tied up into 4 stocks, the majority of it, 70% of his equity portfolio. And the good thing is we're in number 1 and 2 there. Interesting article from Market Bull Ed Yardini. I'm not know how to say it correctly, but I watch him all the time on Trading Nation, and he's always bullish on everything. But I did like his comment on one of the better Christmas seasons ever. Everything's going to be bought off the shelves. Make sure you're doing your shopping early. Ford attracts younger buyers and female. Do read this article. Explanation on why Ford might be really taking off right now. I enjoyed it. Here's a little bit on the House passing the $1.2 trillion bipartisan infrastructure bill. So I guess what is the Democrats on the Senate plus Mitt Romney. But I like the way it sounds. Part of me is just thinking maybe I haven't found where the pork's at. But I like where we're doing some of the infrastructure growth on. The U.S., I mentioned it last week, the U.S. is about to lift its nearly 20-month international travel ban. Here's what you need to know. Here's where you can see a push on airlines. Here's what I think is going to help Boeing out. We're going to start getting people in and out. It'll also help out our sales in general. And I found just a really interesting article. For those of you that are doing Tesla, do understand that about 30 billion shares of Tesla are going to have to start being sold so that he can pay a tax bill on some potential growth that he has in his portfolio. You want to understand how messed up the paying on potential tax, not closed trades taxation and so forth, taxation on possible gains, not actual gains. This is the article to understand why, yes, there are some billionaires that have ridiculous amounts of money, but they've also taken the risk in starting up those companies. They can also take the risk if those companies start to fail. They could see half their money disappear, in a month's period of time. So do read those articles. I do think they will be pretty interesting for you. With that said, any questions you have for me today? We will not be having trade findings and adjustments. Keith's getting LASIK, and I'm doing a bit of a travel on that Thursday, so we will not be having our Thursday trade findings and adjustments. RMDs for IRAs, you typically get that starting the beginning of the year, but you will get calls from us as well as emails from us that will usually start coming out next week. For the most part here at Hurley Investments, we usually try to remind most people to take those RMDs sometime in April or the end of March to pay for taxes. But then we also will touch base with you starting usually just before Thanksgiving, just after Thanksgiving, and around the 15th of December. Just making those reminders so we can get RMDs placed and taken as needed. And I know, Jim, you and I have a little different scenario we're going to do with that one, but just thank you for reminding me. I will put it on my things to look at for tomorrow. Any other questions you guys have? Hello. Interesting question. So the comment was, when are you going to be putting protection back on if the market starts to turn? So the short answer is I will put protection back on when the market starts to turn. Usually you'll see some selling between Christmas and New Year's. Usually you see big money out at least a week before Christmas. So I'm looking at protection this year, looking at a calendar. Serious consideration for protection will be December 13th, which is a Monday, excuse me, through December 17th. That's when I'd be looking to re-add protection for a end of the year sell-off, for taxes, for New Year's, for big money leaving, for thinly traded, for bad news. It would usually be that December 13th through 17th, the week before Christmas. And Christmas this year is on a Saturday, so we'll probably see Friday be the day off for Christmas. Good question. Any other questions? All right, guys, with that said, I appreciate you being here. Thank you very much. We'll get this posted up as quickly as possible. Good to see some things moving on our way. Guys, have a wonderful week. We will see you next week. And also start to look for some emails. Pretty soon here, you'll be receiving emails when your transfers come over. That will be an email that says, okay, click here, and this is how you'll create a password and a login for your new Schwab accounts. We're just not there as we're starting to see some transfers occur. So be ready in the near future for some emails that'll have you saying, okay, here's your new login and password. Click here to create that. All right, guys, talk with you later. Have a good one, and I will talk to you soon. Bye-bye.